You don't lose trades because you're dumb. You lose because you're drowning in noise. Too many opinions, too many signals, too many voices telling you what to do, and none of them telling you who you are when the chart turns red. But in 1957, a man with no screens, no live news, and no Wall Street access found a way to win, silently, systematically, while dancing. His name was Nicolas Darvas. Quick note, this is not financial advice. It's a historical story, told for educational purposes only. Trading carries risk. You can lose your entire capital. Always do your own research and consult professionals before making financial decisions. He wasn't a banker. He wasn't a quant. He didn't wear a suit. He wore a tuxedo, a professional ballroom dancer, a refugee from Nazi-occupied Hungary, and reportedly, a man who turned $36,000 into over $2 million in just 18 months, while performing across the globe. His edge wasn't technology. It wasn't insider tips. It was something most traders never develop: emotional distance and an obsession with structure. Saigon, 1957. Golden lights ripple across a marble dance floor. Darvas spins in perfect rhythm under a crystal chandelier. The audience claps. But he's not smiling because of the applause. In his pocket, a telegram, just 2 numbers. He just made thousands while dancing. Not a performance. A trade. Let's rewind. Toronto, 1952. Darvas is performing in a nightclub. The owner can't pay him fully. Offers 6,000 shares of a small mining company called Breakout instead. Darvas almost refuses. "I nearly used them as cocktail napkins," he later joked. "Would have been expensive drinks." 2 months later, he learns the stock has jumped from 0.50 to 1.90. He cashes out, $8,000 profit. He's hooked, but not ready, because what follows is every beginner's story. He jumps into hot stocks, trusts brokers, buys on excitement, loses everything, again and again, until one night, in a quiet hotel room, far from any trading floor, he stops trying to be smart and starts trying to be systematic. He reads, obsesses, draws, and eventually one idea begins to form. Stocks move in boxes. Darvas imagined the market like a dance. Sometimes it flowed upward, graceful, like a waltz. Other times it tensed, trapped inside an invisible range, like a spring, coiled, waiting to release. He noticed that when price moved sideways long enough, then broke above the range on high volume, it often kept going. That became his system. He didn't need to predict. He just needed to recognize. Box, breakout, volume, entry, that's it. By 1957, he was trading from hotel rooms across Calcutta, Saigon, and Istanbul. Telegrams delivered delayed price quotes. He analyzed charts in silence, placed orders by cable. And according to his reports, his account grew. His brokers were baffled. "You're trading from where? With what?" He didn't have 12 monitors. He didn't scroll Reddit. He didn't care about earnings reports. He had rules, and he followed them like choreography. And here's why this matters, maybe now more than ever, because in today's market, you're not just battling price action. You're battling yourself. Thousands of notifications, contradictory advice, fear of missing out, fear of losing what little you have. Darvas had 1 telegram a day. You have 1,000 distractions per hour. So maybe the real edge isn't more information, it's less. Not being reactive, but being deliberate. Not chasing trades, but waiting for them. Like a dancer waiting for the perfect cue. Darvas wasn't trying to beat the market. He was trying to beat his impulses, his fear, his greed, his chaos. And in the process, he built one of the most discussed technical systems in history, because the best traders aren't the ones who look the smartest. They're the ones who wait. In the next chapters, you'll learn how Darvas drew his boxes, what signals he trusted, how he managed his stops, and why his low-tech, high-discipline method still matters in a high-frequency world. Let's get into the system. Section 2. Why 95% of traders stay stuck. The invisible pattern that Darvas escaped. Let me share something that might sound familiar. Let's be brutally honest. Most traders don't lose because they're lazy. They lose because they're overwhelmed. Too many indicators, too many opinions, too many voices screaming conflicting advice. Picture your trading screen right now. How many tabs are open? How many indicators are flashing? It looks like a cockpit of a fighter jet, doesn't it? Meanwhile, Darvas's trading setup was reportedly a pencil, a napkin, and yesterday's newspaper. Different times, different tools. And when your screen becomes a war zone of flashing candles and technical noise, what happens? You freeze, you chase, you overthink, you sabotage. The noise promises you an edge, but it often delivers anxiety. It whispers hot tips, but it screams when you lose. It's the challenge every trader faces. Statistics suggest that most retail traders struggle to achieve consistent profitability, not because they're incapable, but because they never find a system that works for them. Important note: the Darvas method is not a holy grail. Many traders have failed trying to replicate his reported results. Markets have changed, technology has evolved, but the lessons about discipline and systematic trading remain relevant. Nicolas Darvas didn't start as a genius. He started like most of us, distracted, reactive, hopeful. In his own words, "I was a drunken sailor in a casino, throwing chips at every table." Wait, read that again. He reportedly made money by not watching the market constantly. This approach contradicts modern active trading, but it worked for him. But there was one key difference. He was forced to be distant. Performing across continents, he couldn't check charts every minute. He didn't have CNBC blaring in his hotel room. He didn't hang out with other traders. All he had was week-old copies of Barron's magazine, a few price quotes via Telegram, and a developing pattern recognition system. And that distance, it became part of his approach. Here's what most traders miss. You don't always need more data. Sometimes you need fewer, better decisions. Complexity is often the enemy of execution. Darvas didn't try to predict the market. He didn't read balance sheets or earnings reports in detail. He didn't use complex technical indicators. Instead, according to his book, he said, "I will only buy a stock if it's making a new high. Then, I will wait. If it consolidates for several days without breaking that high, I draw a box. If it breaks out with volume, I buy. If it drops below the box, I'm out. That's it. That's it. No second guessing, no trying to look smart, no ego, just rules, distance, discipline, consideration. Before applying any trading method, consider whether it suits your personality, risk tolerance, and lifestyle. What worked for one person may not work for another. Let's pause and reflect. Have you ever felt yourself stuck in a loop like this? You find a promising stock, you enter, it dips slightly, you panic and sell, then it rises 40%, and you're on the sidelines, frustrated. That feeling when you sell at the bottom, that's a common trader experience. Or you enter too early, then chase a breakout, then revenge trade. Then you close your laptop and swear you'll take a break until tomorrow. Here's why Darvas's system reportedly helped him. It removed many real-time decisions. It forced him to ignore short-term noise. It gave him clear yes, no rules. He created a systematic approach, a framework between his emotions and his execution. And despite primitive tools by today's standards, his reported results were notable. He didn't have TradingView or Thinkorswim. He didn't have YouTube mentors. He didn't have 100 tabs open. He had one thing, a system that worked for his unique situation. So here's a perspective to consider. What if your trading challenges aren't about strategy, but about your relationship to market noise? What if success isn't hiding in more indicators, but in the discipline to follow a consistent approach? Darvas didn't just teach a trading method, he demonstrated how simplicity might work in complex markets. And in a world drowning in information, simplicity can be powerful, if properly applied. Reflection. Exercise. List all the sources of trading noise in your daily routine. Ask, which of these actually help your trading? Now ask, which ones simply make you feel busy? Consider this week, reducing one source of noise, just one, and observe how your clarity changes. We'll return to this concept later, when we discuss how distance affected Darvas's trading. But first, let's get technical. Next up, we'll break down the exact process he described for drawing the Darvas box, the criteria, the entry signals, the risk management, and how traders have adapted this historical method for modern markets. Because what you're about to learn is one of the most discussed and debated trading techniques in market history. Section 3, the birth of the box. How a dancer discovered. One of the simplest trading systems ever. You're about to learn one of the most elegantly simple frameworks in trading history. No complex indicators, no subjective analysis, just price action and a box. But first, let me share the story. This system was reportedly discovered not in a Wall Street office, but in hotel rooms across Asia, with basic tools and limited information. Picture Darvas after a performance studying price patterns. He's sketching on whatever paper is available, looking for patterns. What he discovered would become his signature approach. This system was discovered not in a Wall Street office, but through necessity and observation. Working with delayed information and limited tools, Darvas focused on what he could see clearly: price patterns and volume. And from this limitation came insight, the box. Let's break down exactly how it works, according to his writings. Step 1. Only trade. What's moving Darvas didn't scan thousands of charts. He had one filter. I only trade stocks making new 52-week highs. While many looked for bargains, Darvas focused on strength. Why? Because momentum can attract more momentum. Strong stocks often continue being strong. If a stock wasn't making a new high, he reportedly skipped it. No emotions, no excuses. Consideration. This approach means missing many stocks that recover from lows. It's a momentum strategy, not a value strategy. Lesson from history. Focus on strength was Darvas's choice. Your approach may differ. Step 2. Draw the box. Here's where his method becomes specific. Let's say stock X hits a new 52-week high on Monday. Darvas would then observe the next few days. If Tuesday, Wednesday, and Thursday all fail to break Monday's high, he locks in that high as the top of the box. Then, he watches the lows during that same period. If 3 consecutive days fail to make a lower low, he sets the bottom of the box. That's it. You now have a price range, a box, that represents consolidation. Visualize it. A stock makes a strong move up. Then it trades sideways in a range. That range becomes your reference zone. Think of it like a coiled spring. The consolidation might lead to continuation or reversal. Step 3. Wait for breakout plus volume. Here's where discipline becomes crucial. Most traders might jump early. Darvas reportedly waited. He only entered if the stock closed above the top of the box. The breakout happened with significantly higher volume than average. Why the volume requirement? Because volume can indicate conviction. Low volume breakouts often fail. High volume might suggest institutional interest. Imagine a concert where only 10 people show up versus 10,000. Volume can reveal genuine interest. He didn't chase rumors. He followed price and volume. First the price moves, then explanations often appear. Step 4. Define your risk with stop loss. Before entry, Darvas knew his exit. His stop loss just below the bottom of the box. This meant, if the breakout failed, he'd lose a defined amount. But if the trend continued, he could stay in. It wasn't about being right all the time. It was about managing risk when wrong. He approached it systematically, not emotionally. Hope is not a strategy could describe his approach. Step 5. Trail. Your stop with new boxes. As the stock rose, new boxes would sometimes form. When that happened, Darvas would raise his stop loss to the bottom of the new box. This gave him 2 potential advantages. Locking in some profits, staying in trends longer. This method created what he called a staircase effect. Each new box equals potentially higher stop. Each stop adjustment equals some profit protection. Let's recap the framework. New high, put on watch list. Box forms, identify range. Breakout on volume, potential entry. Stop loss equals below box bottom. New boxes, adjust stops. Simple in concept, challenging in execution, because it requires patience and discipline. Historical example. Darvas wrote about trades like Lorillard, where he reportedly bought after breakout, added to positions as new boxes formed, rode significant moves. He claimed substantial profits using this approach. The key? He checked prices infrequently. Most day traders today check constantly. Different approach entirely. All without daily monitoring. All from distant locations. All by following his systematic rules. Your turn. Paper trade practice. 1. Find a stock at new 52-week highs. 2. Watch for 3 days that fail to exceed that high. 3. Identify 3 days that hold above a low. 4. Draw your first Darvas box. 5. Watch. Wait. Observe breakout plus volume. Even if you don't trade it, observing helps understand the concept. In the next section, we'll examine the mechanics behind box formation and why price consolidation happens. Important. Past performance doesn't guarantee future results. What worked in one era may not work in another. Time to understand the framework better. Section 4. Inside the box, the math behind momentum. Let's examine the mechanics more closely. You've drawn your box. You're watching price move within it. Now comes the question every trader asks. Why do stocks pause after hitting new highs? Because markets often move in waves. A breakout is expansion. The box is contraction. What comes next could be either direction. The Darvas Box attempts to capture this rhythm, helping traders identify potential continuation patterns while managing risk. Here's the box framework in detail. 1. Box top, upper boundary, defined by a new 52-week high, confirmed when the next 3 days of highs stay below that level. Market psychology. After a strong move, uncertainty often emerges. Buyers may hesitate. Sellers may test. A range develops. Think of it like a high jump bar. The market is deciding whether to attempt another leap. 2. Box bottom, lower boundary. After the top is set, identify the lowest low in that range. Confirm when 3 consecutive lows stay above that level. Market psychology. This level may represent where buyers step in. It's a potential support zone. It's like a floor where price finds temporary stability. Now you have your box. Top equals recent resistance. Bottom equals recent support. Can you see the tension building? Measuring risk. The box height. Subtract bottom from top. Box height equals top. Bottom. This tells you 2 things. Your potential stop-loss distance. How to size your position based on risk. Example, box top equals 105. Box, bottom equals $98. Height equals $7. If you only want to risk 210 on the trade, you could buy 30 shares because 30x $7 equals 210. This is mathematical risk management, not guesswork. Most traders, I'll just buy some shares and hope. Systematic traders, I'll size according to my risk tolerance. Note, if you can't calculate position sizes, practice on paper first. 4. Breakout criteria, volume plus. Price Darvas didn't chase every breakout. He wanted evidence of conviction, shown through volume. His reported rule, breakout volume should be significantly higher than recent average. Why? Because price without volume is movement without conviction. Price plus volume might signal genuine interest. It's the difference between one person clapping and a stadium erupting. Volume can reveal the scale of interest. You're not trying to outsmart institutions. You're trying to identify when they might be active. Remember, retail traders are small fish. Institutions move markets. 5. Entry and stop setup. Once you see a confirmed close above the box top with heavy volume, consider entry the next day. Place your stop loss below the box. Bottom, the tighter the box, the more precise your risk. But beware, very tight boxes may produce false signals. Pro consideration. If a box is less than 3% tall, it might be too tight. Look for reasonable volatility. Bonus, the projected box concept. Sometimes a stock runs hard after breakout, too fast for a new box to form. Modern practitioners sometimes use this adaptation. Take the previous box height, project it upward. Use that projection to guide stops. This helps stay in strong trends without clear consolidation. Imagine climbing stairs in darkness. You estimate the next step height based on the previous ones. Now, let's examine why this might work. Boxes represent consolidation. Markets often pause before continuing. Breakouts can trigger momentum. When ranges break, movement often follows. Trailing stops aim to protect gains. Systematic exits remove emotional decisions. Rules help maintain discipline. You're following a plan, not reacting to fear or greed. Real-world analogy. Think of the box like a compressed spring. The longer the compression, the potential for movement. But direction isn't guaranteed. Darvas looked for the breakout to signal direction. Try this exercise. Open any charting platform. Find a stock at 52-week highs. Apply the 3-day rule to identify a box. Calculate the box, height, and risk. Note the average volume versus breakout requirements. This isn't financial advice. It's pattern recognition practice. Soon you'll start seeing these patterns more clearly. Up next, We'll examine how Darvas managed winning positions, his approach to letting profits run while protecting capital. This is where risk management becomes critical, because entry is only the beginning. Managing the trade is where outcomes are determined. Section 5. Stacking profits like stairs. The art of the trailing stop. Let's say you entered a trade using the Darvas Box method. The stock breaks out on volume. You're in. Now what? Most traders immediately think, when should I take profits? This question reveals a common challenge, because trying to predict tops is difficult. You'll often be too early or too late. Darvas had a different approach. Let the market tell you when to exit. Imagine trying to guess when a trend will end. You might leave early and miss gains, or stay too long and give back profits. Neither is ideal. How did he approach this? By using new boxes as trailing stops. The principle of the trailing stop? Darvas didn't use fixed profit targets. He used the bottom of newly formed boxes as trailing stops. Here's the process he described. 1. You enter when the stock breaks above box, number 1. 2. It rises, then consolidates again. 3. A new range forms, box number 2. 4. Once box number 2 is confirmed, same 3-day rule, raise your stop to the bottom of box number 2. Continue this process. Every new box equals potentially higher. Stop. Every higher stop equals some profit protection. This approach attempts to balance two goals, letting profits run while protecting gains. Profits aren't necessarily taken at predetermined levels. They are protected through systematic stop adjustment. Why this might work? Consider trader psychology. Most traders either exit too early, fearing loss of gains, exit too late, hoping for more. It's a challenging balance without a system. Darvas's approach attempts to remove emotional decisions by using market structure to guide exits. You don't guess when the trend ends, you wait for the market to show you. Metaphor, the escalator approach. Picture riding an escalator that occasionally pauses. If it keeps moving upward, stay on. If it reverses, step off. The box system is designed to keep you in while the trend continues. When it breaks, you exit with some profits preserved. This removes emotional interference from exit decisions. Historical example, trailing in action. Darvas wrote about trades where he entered after initial breakout, raised stops as new boxes formed, stayed in for extended moves, exited when box support broke. He reported capturing substantial portions of trends using this method. Key insight: he avoided trying to pick tops. He let the market structure guide him. But what if no new box forms? Sometimes stocks run without clear consolidation. Modern adaptations include using the previous box height as reference, projecting that height upward, creating projected boxes for stop guidance. This helps manage positions in strong trends without clear consolidation patterns. Think of it as estimating based on recent behavior when clear signals aren't present. What makes this psychologically challenging? Let's be honest, trailing profits feels uncomfortable. Your mind might say, take the money before it disappears. But systematic traders think differently. Let the position play out according to plan. Your job isn't to predict, it's to follow your system. This represents a fundamental shift from prediction to reaction based on predetermined rules. Because it's not just a tactic, it's a mindset shift. Reflection. Questions? Ask yourself, have you exited trades early, then watch them continue higher? Do you tend to take small wins but larger losses? Are you more afraid of giving back gains or missing potential profits? Consider, what if patience and systematic exits could improve your results? Practice exercise, historical analysis. Take any chart showing a strong historical trend. Apply the Darvas Box concept. Mark where new boxes would form. Note where stops would adjust. Compare to picking arbitrary exit points. You'll see how systematic trailing works versus emotional decisions. This builds understanding of the concept. Practice before risking capital. In the next section, we'll examine volume's critical role. Because without volume confirmation, boxes may be less reliable. Volume isn't just data. It's the market revealing its conviction level. Understanding volume helps separate genuine moves from false starts. Section 6. When to enter, when to run. Volume as the secret gatekeeper. Price tells you what is happening. Volume tells you how significant it might be. That's why in the Darvas Box method, a breakout without volume is like enthusiasm without action. It might be meaningless. Volume is considered critical to this strategy, and Nicolas Darvas reportedly didn't enter a single trade without volume confirmation. He understood discipline matters more than frequency. The volume principle, Darvas's reported rule. Only buy when price breaks out with significantly higher volume than recent averages. This helped him filter potential false moves from stronger signals. Because institutional activity often shows through volume. When large players move, they leave footprints. Those footprints appear as volume surges. Think of volume as market enthusiasm. It reveals participation levels. A low participation might mean weak conviction. But what is volume? For newer traders, volume simply means the number of shares or contracts traded in a given period. Higher volume equals more trading activity. But context matters. Strategic volume occurs at key levels, breakouts, breakdowns, or reversals. Random volume during consolidation means less. The focus, volume at decision points. 3 types of breakouts you'll observe. Type 1, low volume, potential false breakout. Price briefly exceeds the box, but volume stays average, often reverses quickly. Darvas would reportedly avoid these. Visual, like a door opening with no one walking through. Type 2, medium volume, uncertain signal. Price breaks out with modest volume, increase might continue or reverse, requires careful observation. Visual, some interest, but not overwhelming. Type 3, high volume, stronger confirmation. Price closes above box top with multiple times average volume, suggests stronger interest. Darvas's preferred entry signal. Visual, clear enthusiasm and participation. If volume isn't confirming, patience is required. Modern reality, volume in today's markets. But wait, you might think, isn't volume different now with algorithms and high-frequency trading? Valid observation. Yes, market structure has changed, but volume patterns still matter. While computers create some noise, significant volume at breakouts still often indicates genuine interest. Modern adaptations include using longer-term average volume, 20-50 days, looking for 2 to 4x normal volume on breakouts, confirming with price action follow-through, using volume profile tools for additional context. Your trading checklist, before considering any breakout trade, is this a genuine 52-week high? Has a clear box formed? Did price close above the box top? Is volume notably above average? Can you define your risk clearly? If any answer is no, waiting might be prudent. Remember, markets reward patience more often than impulsiveness. Volume psychology. Why it matters. Consider institutional behavior. Large funds can't buy millions of shares instantly without moving price. They often accumulate gradually. When ready to move aggressively, volume increases. That surge might signal conviction. Darvas looked for proof of interest, not promises. It's about evidence versus speculation. Common mistake, chasing price alone. Volume surge alone doesn't mean buy. The combination matters. Price breakout plus volume surge equals stronger. Signal price alone equals weaker signal. Wait for both elements to align. Think quality over quantity. Volume pattern recognition. Exercise. 1. Open your charting platform. 2. Find 10 recent breakouts in different stocks. 3. Note volume on breakout day versus average. 4. Track whether price continued or reversed. 5. Look for patterns. You'll likely notice low volume breakouts often fail. High volume breakouts show better follow-through. But nothing works 100% of the time. This is pattern recognition, not guaranteed prediction. In the next section, we'll explore modern adaptations, how traders today modify Darvas's concepts for current markets. We're evolving the historical method for contemporary application. Remember, all trading strategies require adaptation and risk management. Section 7, Ghost Boxes and Modern Hacks, evolving Darvas for today. The market in Darvas's time was different. Orders traveled by telegram. News arrived slowly. Charts were hand-drawn. Today, electronic markets, algorithmic trading, instant information, and 24/7 global access. So, does the Darvas Box concept still apply? Potentially, but with adaptations. Let's explore ghost boxes, a modern evolution helping traders manage positions when traditional boxes don't form clearly. This concept has helped some traders stay in trends longer, but like all methods, it's not foolproof. The challenge with classic boxes today. Darvas's method relied on clear consolidation patterns. Breakout occurs, consolidation forms. New box appears. But modern markets, especially growth stocks and ETFs, sometimes move differently. Parabolic moves without clear consolidation. Vertical price action. Traditional response options. Exit early without a new box. Hold without clear stop guidance. Neither ideal for systematic trading. The solution: ghost boxes, projected boxes. Ghost boxes are projected ranges based on previous box dimensions. Think of them as estimated guidelines when clear patterns don't emerge, like using yesterday's map when today's isn't available. How to build a ghost box. Example scenario. Last confirmed box, 92-100, height equals 8. Price breaks out to 113 without consolidating. Approach. 1. Take the 8 box height. 2. Project upward. 108-160 out potential range. 3. Use 180 as temporary trailing stop reference. 4. Continue projecting until real consolidation appears. You're not predicting, you're applying consistent risk management when clear signals are absent. This attempts to balance staying in trends while maintaining discipline. Combining with moving averages, use 20-day and 50-day EMAs as additional reference. If price stays above both, trend might be strong. EMAs can guide stops when boxes aren't clear. Think of EMAs as supplementary information, not primary signals. 2. Momentum indicators for context. RSI or MACD for additional perspective. Extreme readings might suggest caution, but price action remains primary. Remember, indicators support. They don't replace price analysis. 3. Volume profile analysis. Identify high-volume price zones. These might act as support resistance. Breakouts from low to high-volume zones can be significant. 4. Backtesting before live trading. Test concepts on historical data. Use paper trading first. Track results objectively. Actual results from various backtests show mixed performance across different markets. Better results on longer time frames. Importance of market conditions. These aren't predictions. They're observations requiring personal verification. Weekly learning exercise. Choose a trending stock. Identify the most recent Darvas box. If price breaks out without forming new box, project using previous height. Mark theoretical stop levels. Journal your observations. Does this help clarify risk? How does it feel versus arbitrary stops? Why this matters. Ghost boxes aren't just technical modification. They represent systematic thinking. I don't need perfection. I need consistency. It's the difference between reactive and systematic trading. With practice, pattern recognition improves. Consideration for modern traders. Let's say you're managing a winning position. No clear consolidation forms. What do? A. Exit because there's no new box. B. Hold with no clear stop. C. Project based on recent behavior. Systematic traders often choose C, but with full understanding of limitations. Next, we'll explore a crucial psychological element: why being distant from markets might actually help some traders. Darvas made his trading decisions away from Wall Street. What he discovered challenges our assumption that more information equals better decisions. Prepare to reconsider screen time equals success. Because sometimes the best trading happens when you're not watching. Section 8. The power of distance. How? Being far from the market saved Darvas. We live in a world that celebrates constant connectivity. Refresh Twitter, check the chart, watch the candles dance. It feels like being plugged in equals being professional. But what if constant monitoring sometimes hinders performance? What if watching every tick increases emotional reactions? Nicolas Darvas didn't just succeed despite being far from Wall Street. His distance was reportedly integral to his approach. Consider this. The man who reportedly made millions spent less time watching markets than many losing traders. His edge wasn't information. It was selective ignorance. Let's examine the 1950s context. Darvas was performing globally. He danced in Saigon, Calcutta, Istanbul. Market updates came via delayed telegram. Charts arrived in week-old magazines. Yet, according to his accounts, he built substantial wealth. No real-time feeds, no constant alerts, no social media influence. Today's traders have unlimited information, yet many struggle. Why might that be? He had distance, and that distance reportedly gave him emotional clarity. The psychology of market monitoring. Research on trading behavior suggests interesting patterns. Frequent portfolio checking correlates with certain behaviors. More impulsive decisions, increased overtrading, emotional reactions to normal volatility, reduced performance for some traders. Why? Because human psychology evolved for immediate threat response. Our ancestors survived by reacting quickly to danger. That same wiring can work against us in markets. Every price movement can feel urgent. Every red candle might trigger fear. Constant exposure might amplify emotional responses. Darvas's forced discipline. His performance schedule created natural boundaries. By the time he received price data, immediate action was impossible. He couldn't micromanage positions. He couldn't react to every fluctuation. He developed rules. He followed them. Then he returned to his primary profession. Consider this approach. The best trades might be those you don't interfere with. While you're watching every tick, someone else might be letting their plan work. The modern challenge, information overload. Today's traders face different challenges. Chart addiction symptoms, checking positions constantly, letting news override systems, emotional exhaustion from overexposure. Ask yourself honestly, are you trading systematically or reacting to information overload? Thought experiment, structured distance. Imagine this approach. Weekend analysis and planning, alerts only for specific setups, orders placed in advance, stepping away from screens. Could this work for you? Results would vary by individual. Darvas found distance helpful, others might not. Real story. When Darvas returned to New York, his book describes an important lesson. After success abroad, Darvas tried trading from New York. He rented space near Wall Street, surrounded himself with market noise, had access to constant information. The result? He reported significant losses quickly. He wrote that proximity made him impulsive. The environment affected his judgment. I could hear brokers shouting. Every shout felt like opportunity or threat. He also described a painful lesson from Manila. Watching a profitable position reverse overnight. He'd broken his own rules, let emotion override system, lost substantially. The next morning, he reinforced his discipline. Never again would emotion control execution. The system wasn't born from theory. It emerged from expensive lessons. His response? He left New York again, back to distance, back to discipline, back to his systematic approach. His results reportedly improved. Sometimes space creates clarity. This led him to observe what modern behavioral finance calls the information paradox. More information, better decisions. More information equals more noise equals potential for worse results. Having more data often leads to overconfidence or confusion. Quality of decisions matters more than quantity of information. Darvas found distance helpful by necessity. Modern traders must choose their approach consciously. Creating emotional distance. This week, consider experimenting. Set specific market hours. Avoid constant monitoring. Use price alerts strategically. Let technology watch for you. Create physical separation. Trade from one location only. Develop post-trade rituals. Clear mental space after decisions. Notice changes in stress levels. Decision quality. Trading results. Why this matters today. In 2025, information is infinite, but clarity remains scarce. The trader who manages information flow might have advantages over one drowning in data. Darvas wasn't superhuman. He simply couldn't access constant noise. In that limitation, he found structure. He found discipline. He reportedly found success. Next, let's examine a counterintuitive concept, the belief that more discipline always helps, when it might sometimes hinder. What if conventional trading wisdom has it backwards? Darvas learned expensive lessons, and his insights might surprise you. Section 9. Why most traders fail. Discipline is not always the solution. You've heard it repeatedly. You need more discipline to succeed. Your losses are due to lack of control. Just follow the rules harder. But what if that's oversimplified? What if excessive focus on discipline sometimes creates new problems? Consider this perspective. Darvas learned through expensive mistakes and reached surprising conclusions. Here's what many traders attempt: create elaborate routines, set multiple rules, monitor constantly, promise perfect adherence, enter position, market moves against them, stress builds, rules break down, emotional decisions follow regret and self-blame. Familiar pattern? They call this discipline, but it might be willpower exhaustion, and willpower is finite. Trying to maintain perfect control indefinitely is like holding your breath. Eventually, you must breathe. The Darvas Discovery. His book describes a crucial realization. When trading from New York, he thought, "I'm now professional. I should monitor everything constantly. More information, more decisions, more control." So he tried it. Constant market exposure, endless information flow, rapid reactions, maximum discipline. The result? Significant losses quickly. He wrote, "When distant, I followed my rules. When close, I broke them. My ears became my enemy." Think about that. His ears were the problem. The constant input overwhelmed his system. The hidden cost of hyper-control. Trying to control everything might feel productive, but sustainable success often comes from smart structure, not brute force. Darvas didn't succeed through superhuman discipline. He succeeded by designing systems that required less constant willpower. He created clear entry criteria, defined exit rules, limited decision points, natural distance from noise. He automated discipline through structure, like habits versus constant decisions. One is sustainable, the other exhausting. That's what many miss. Understanding decision. Fatigue, every decision consumes mental energy. Should I check the chart? Should I adjust my stop? Should I take profits? Should I add to position? Make too many decisions and quality degrades. Darvas reduced decisions through systematic rules. That's why he didn't monitor constantly. That's why he used clear signals. The system was designed to preserve mental energy. Trading reality. Check, have you experienced this? Perfect plan, created rules. Ignored under pressure. Stops moved just once more. Discipline promises broken. That's not character failure. That's system design issues. Design over discipline. Darvas's insight wasn't just technical. It was psychological architecture. He structured entry, only on clear signals. Exit, predetermined levels, monitoring, minimal by necessity. Decisions, reduced to essentials. Once structure was set, the structure decided. Less human interference meant fewer emotional errors. Freedom isn't infinite choices. It's making the right choices automatic. Try this. Decision audit review. Your last 5 trades. How many decisions per trade? Which followed your plan? Where did emotions override logic? What triggered plan abandonment? Then ask, am I relying on willpower or structure? If mostly willpower, you're fighting human nature. Design systems requiring less moment-to-moment discipline. Build sustainable approaches. Important consideration. Where in trading do you rely on strength instead of structure? In the next section, we'll examine a belief the most traders never question. The assumption that buying low is always smart and buying high is dangerous. Darvas challenged this conventional wisdom, and his reasoning might shift your perspective. Historical note. Different strategies work in different market conditions. What follows is one approach, not the only approach. Section 10. Don't buy cheap. Why buying high might be worth considering. Let's examine a common assumption. You've been taught. Buy low, sell high. Sounds logical, right? It's probably the first trading advice you received. But here's what Darvas discovered through experience. Stocks that look cheap often get cheaper, and stocks making new highs, they sometimes continue higher. Consider both sides of this controversial approach. The value trap challenge. Scenario. A stock drops from $100 to $60. Common thinking, 40% discount. Great opportunity. Your mind says, everyone's panicking. I'm getting a bargain. But what often happens? Company facing real challenges. Momentum turning negative. Institutions potentially exiting. Bargains becoming worse. Darvas reportedly learned this through losses. He initially sought cheap stocks. I was bargain hunting in damaged goods. Eventually, he shifted focus. Markets often reward strength over apparent value. The psychology of buying strength. Buying at new highs feels uncomfortable. It contradicts instinct. Inner voice, it's already up so much, too late. But that discomfort, some traders view it differently because most people avoid it, which might create opportunity. Darvas reportedly reframed his thinking. I buy stocks going up, not stocks that might go up. Not based on stories, not based on hope. Based on observable momentum, comparing two approaches. Trader A buys at $30, down from $70. Seems logical, but it keeps declining. 6 months later, $15. Trader B buys at $70, new high with volume. Feels expensive, but momentum continues. 6 months later, potentially higher. Who had better odds? The one following strength. Of course, nothing is guaranteed. Both trades could lose. Historical example, Darvas's approach. His book describes buying after stocks had already risen, didn't catch bottoms, waited for strength confirmation, paid higher prices than early buyers. Others thought it illogical, buying after 30% rise, but he focused on confirmed momentum, volume-backed moves, institutional interest potentially present, trend already established. The controversial result, he reported significant gains, late entries based on confirmation. Early buyers might still be underwater. The mental barriers, buying strength triggers fears. 1. Am I too late? 2. What if it reverses? But consider this reframe. If it reverses, I have stops. If it continues, I'm positioned. The goal isn't perfection. It's favorable risk-reward based on momentum. Like joining momentum already in motion rather than hoping for reversal. Perspective. Expensive might mean demanded. When are stocks potentially riskier? Falling on weak volume. Cheap but can't rally. Ignored by institutions. When might they be stronger? Breaking new highs with conviction. Volume confirming interest. Already moving with momentum. Darvas's observation? Cheap stocks are often cheap for reasons. Strong stocks can get stronger. But remember, this is one approach among many. Value investing works for others. Price bias self-assessment. Review your trading history. Trades entered because stock had fallen significantly, near 52-week lows, seemed too high. Compare to trades entered on strength, already trending positions, which performed better overall. Results vary by market conditions and individual execution. Exercise. Reframe your entry thinking. Scan for new 52-week highs. Identify 3 with potential box patterns. Set alerts for breakouts. Promise yourself, I'll evaluate based on momentum, not price level. This isn't blind following. It's considering strength as entry criterion. Darvas didn't profit from predictions. He reportedly profited from participating in existing trends. Trading involves various valid approaches. This historical method represents one perspective worth understanding. In the next section, we'll examine a specific trade that became legendary. A company Darvas knew nothing about, yet reportedly produced exceptional returns. This story illustrates his systematic approach in action. It's time to see theory meet practice. Section 11. The box that made history. A trade study. Imagine this scenario. You're performing in Calcutta. Between shows, you check telegrams. One mentions a stock called E.L. Bruce hitting new highs. You know nothing about the company, not the industry, not the products, not the fundamentals. Yet the chart shows a clear box pattern, strong breakout potential, volume building. Do you act on the system or skip the unknown? This was Darvas's actual decision, and what followed became one of his most discussed trades. Who was E.L. Bruce? E.L. Bruce was a hardwood flooring company. Not technology, not innovation, just flooring. Hardly exciting business. But Darvas reportedly didn't care. He wasn't investing in stories. He was trading price patterns. The technical setup, stock made new highs, clear box formation, volume increasing. So he acted. His broker questioned, "Do you know what they do?" His response, "Does it matter?" Then external events intervened. The catalyst. After Darvas entered, corporate drama unfolded. A takeover attempt emerged. Short sellers were caught wrong. Institutional buying accelerated. The stock moved dramatically higher. And because Darvas was already positioned, following his system, he didn't need to react to news. He held his position. From entry around $51, the stock reportedly climbed significantly. He sold in stages, protected profit systematically. exited at much higher levels. Reported result? Substantial gains in weeks, in today's context, would represent life-changing money for many from a flooring company without fundamental analysis. The key insight. Darvas reportedly stated, "I never bothered learning what E.L. Bruce manufactured. It wasn't relevant to my method." While others analyzed financial statements, Darvas followed price and volume, pure technical approach. No emotion, no narrative, just systematic execution. Price moves first. Stories follow. Lessons from this trade. Systems over stories. Most wait for fundamental reasons. Price volume can signal early markets often know before news. 2. Position before news. He entered on technical signal. News came after entry system positioned him advantageously. 3. Letting winners run. Didn't exit on first profit. Followed trailing, stop method. Captured larger move. 4. Conviction in method. Sized appropriately, followed rules despite ignorance. When correct, meaningful position. Trade analysis. The setup. Box, top, $51. Box, bottom, 47 volume, multiple times average. Stop, below box. As price rose, new boxes formed. Stops adjusted higher, position protected. Each consolidation equals higher floor. Each breakout equals continued participation. Systematic approach, not prediction. Many would have sold early calling it good profit. The box method kept him in longer. Why most would miss? This common objections? Unknown company. Already up too much. Wait for pullback valuations too high. Or worst, just watch it. Darvas had one question. Does it fit the system? Yes equals act. No equals pass. No paralysis. No overthinking, just execution. The deeper message, consider this. Are you trading based on compelling narratives, chart patterns, and systems? Darvas showed that systematic approaches could work without fundamental knowledge. Controversial? Yes. But historically noteworthy. Practice exercise. System-based analysis. Using historical charts. 1. Find stocks that made major moves. 2. Identify box patterns before moves. 3. Ignore what company does. 4. Rate setup quality only. 5. Note if you would have acted. This trains pattern recognition separate from bias. Not about finding the next E.L. Bruce, about developing systematic thinking. In the next section, we'll examine modern evidence. Does this historical method show any validity today? Time-tested or outdated? Let's examine what backtesting reveals about the Darvas approach in contemporary markets. Remember, past performance never guarantees future results. Every era differs. Section 12. Darvas versus modern markets. What testing reveals. It's natural to wonder about historical methods. A dancer's success in the 1950s, telegrams and weekly magazines, different market structure entirely. Valid question for 2025. Does this approach show any continued relevance? Let's examine evidence beyond anecdotes, because while stories inspire, data informs, and results might surprise you. Academic analysis, the Bulkowski studies. Thomas Bulkowski, respected technical analyst, conducted extensive testing of various chart patterns. His work included examining box breakout patterns, testing parameters, hundreds of stocks, multiple market conditions, various time frames, systematic methodology. Published findings deserve consideration. The results. Context matters. 1. Short-term implementation. Win rates varied significantly. Many false breakouts, challenging for day trading. Whipsaw prevalent key finding. Noise dominates short time frames. 2. Longer-term application. More consistent patterns emerged. Weekly, monthly time frames showed improvement. False signals reduced. Trending markets favorable. This suggests time frame selection matters significantly. Critical insight. The method shows different results based on application. Short-term, challenging. Longer-term, more viable market conditions. Crucial factor. Sound familiar? Darvas checked weekly, not daily. The reality check. No system works universally. Darvas acknowledged losses. Success required appropriate market conditions. Discipline and execution. Risk management, always accepting failures. Modern traders report mixed results. Some find value in the concept, others struggle with implementation. Market evolution affects patterns. Individual execution varies greatly. Adapting for contemporary markets. Current practitioners often modify. 1. Time frame adjustments. Weekly charts over daily, avoiding micro time frames. Patience for clear patterns. 2. Market selection. Liquid stocks, GEARS ETFs, preferred avoiding penny stocks. Sector strength consideration. 3. Volume confirmation. Accounting for algorithmic activity. Relative volume more important. Institutional footprint still visible. 4. Risk management evolution. Tighter stops in volatile markets. Position sizing crucial portfolio approach. 5. Realistic expectations. Not every setup works. Market conditions matter. Consistency over home runs. Why patterns might persist. Consider market psychology. Despite technological change, humans still feel fear, there's greed. Consolidation still occurs. Breakouts still attract attention. Volume still reveals participation. Darvas identified human behavior patterns. Technology changed, psychology didn't. That's why certain concepts endure. Practical testing approach. Before risking capital, 1. Historical analysis. First, 2. Paper trade extensively. 3. Start very small. 4. Track results honestly. 5. Adapt based on evidence. Expect initial struggles. Learning curve, need for modifications. Mixed results. This is skill development, not instant success. The honest conclusion. No historical method works unchanged forever. Markets evolve. Strategies must adapt. But core concepts often contain wisdom. Systematic approaches help risk management matters most. Discipline beats impulsiveness. Simple often outperforms complex. Whether using Darvas concepts or others, test, verify, adapt, manage risk. Next section, practical implementation. How do modern traders apply these concepts? What tools help identify patterns? Where do beginners start? Let's make history practical for today. Remember, this is education about market history and technical analysis, not personal financial advice. Always consider your unique situation. Section 13. How to start. A practical learning guide. You understand the history, you grasp the concepts, now comes implementation. This section provides practical steps for exploration. Remember, start with education, not capital. Learn through observation before risking money. No promises, just structured learning, no hype, just systematic study. You don't need expensive tools, you don't need complex software, you need curiosity and discipline. Let's begin. Step 1. Choose your learning platform. Free charting options, TradingView, comprehensive free tier, Yahoo Finance, basic but functional, broker platforms, if you have account, stockcharts.com, good educational resources. Start simple. Free tools suffice for learning. Search Darvas Box on TradingView. Various free indicators exist for study. Note, test any indicator thoroughly. Not all are created equal. Step 2. Learn through observation. Before trading, observe, daily exercise. Find stocks at 52-week highs. Watch for consolidation patterns. Note, box formations, track breakout behavior. Observe volume patterns. Do this for 30 days minimum. Pattern recognition develops through repetition. Step 3. Practice box identification. Manual drawing teaches best. Top boundary. Recent high holding for 3+ days. Bottom boundary. Recent low holding for 3+ days. Mark these levels. Watch what happens. Note success and failure patterns. Create a study journal. Stock symbol, box dimensions, breakout date, launch, volume, result. Learning requires documentation. Step 4. Understand alerts, don't overtrade. Most platforms offer price alerts. Set above box top. Require volume confirmation. Don't act on every alert. Quality over quantity. Alerts are tools, not commands. Step 5. Risk management. First, Before any real trading, learn position sizing. Account size matters, risk per trade defined, box height determines shares. Never risk money you need. Example only, $10,000 account, 2% risk equals $200 maximum, $5 box height, maximum 40 shares. This is mathematics, not gambling. Paper trade until consistent. Step 6. Study trailing concepts. Practice on historical charts. Identify past trends, mark box formations, note where stops would adjust, calculate theoretical results. Understanding comes before execution. Step 7. Develop your process. Create personal guidelines, observation routine, analysis method, entry criteria, exit rules, review process. Your plan, your rules, your responsibility. Learning challenge. 30-day observation. Week 1 to 2. Pure observation. Watch 10 stocks daily. Note patterns only. No trading. Week 3-4. Paper trading. Apply concepts theoretically. Track imaginary results. Learn from mistakes risk-free. After 30 days, assess. Pattern recognition improving. Emotional reactions noted. System understanding growing. Only then consider small real trades. Important reminders. Education. First, read Darvas' book for full context. Risk awareness. Most traders lose money. Continuous learning, markets change, keep adapting, personal responsibility. Your decisions, your results. What you'll experience. During observation phase, patterns become clearer. Noise becomes obvious. Patience develops, discipline builds. Not through forcing, through consistent practice. You're not becoming a trader overnight. You're developing market observation skills. That's how sustainable learning happens. In the next section, broader life applications. Because systematic thinking extends beyond markets, box concepts apply to more than stocks. The principles transfer to any domain requiring disciplined decision-making. Section 14. Beyond trading. Life lessons from boxes. The Darvas Box transcends market mechanics. It's a framework for thinking, a lens for viewing challenges, a structure for navigating uncertainty. Behind every trading system lie deeper principles. What Darvas discovered applies beyond charts. Let's explore broader applications. 1. Information. Filtering in daily life. Darvas had limited information by necessity. That constraint became strength. Life parallel. We drown in data daily, but wisdom requires filtering. In your life, what noise masquerades as necessity? This week, identify 5 information sources that add stress without value. Markets don't punish you. They reveal decision quality. 2. Preparation. Over prediction. Darvas didn't forecast markets. He prepared for movements. He positioned for opportunity, then responded to reality. Life application. You can't predict everything, but you can prepare for possibilities. Career changes, relationships, health. Preparation beats prediction. Like updating skills before needing them, ready when opportunity appears. 3. Structure enables. Freedom. Darvas didn't trade randomly. Rules created freedom from emotional chaos. Because clear boundaries reduce decision fatigue. Life parallel. Routines aren't restrictive. They're liberating. Good habits, clear boundaries, defined goals. Structure creates space for what matters. Where do you need more structure to gain freedom? Every random decision drains energy from important ones. 4. Middle participation beats perfect timing. Darvas didn't catch exact bottoms, didn't sell exact tops. He captured profitable middles. Life lesson, perfect timing is impossible. Participation during growth matters more. Starting businesses, learning skills, building relationships. Begin when ready, not when perfect. The middle contains most opportunity. 5. Cutting losses, running winners. Darvas used stops religiously. Small losses, larger gains, asymmetric approach, life application, know when to persist, know when to pivot, bad relationships, failed projects, unhelpful beliefs, cut quickly, good relationships, working strategies, positive habits. Let them compound. What needs cutting? What deserves patience? Most hold the wrong things too long. 6. Progress through levels. Each Darvas box represented a level. Break higher. Establish new floor. Temporary setback. try again, not straight lines. Stair steps, life parallel, growth happens in stages, consolidation, breakthrough, new level, career progression, skill development, personal growth. Expect plateaus between advances. What box currently contains you? What would breaking out require? 7. Distance creates clarity. Darvas's geographic distance helped. Less noise, better decisions. He couldn't micromanage. Had to trust systems. Life wisdom. Sometimes stepping back helps. Constant involvement can hinder. Parenting, managing, creating. Strategic distance often helps. Where might less involvement improve outcomes? Tomorrow, try 10 minutes of morning silence. Notice what emerges without input. These aren't just trading concepts. They're decision-making frameworks. Applicable anywhere systematic thinking helps. Darvas showed that constraints can become advantages, that simple systems can outperform complexity. That discipline beats brilliance. Whether trading or living, build your boxes, define your rules, follow your system, manage your risks. And remember, not every breakout succeeds, but systematic approaches improve odds. In our final section, synthesis. What matters most from this journey, because information without action merely entertains. Time to crystallize learning into possibility. Section 15, your path forward, building your own boxes. Let's synthesize this journey. You started with a dancer's story, a refugee who found an unusual path, limited tools, clear thinking, systematic approach. And you've discovered timeless principles, from $36,000 to reported millions. Not through complexity, through clarity, following one core insight. Markets move in patterns. Identify them, follow them, manage risk always. What you now understand. Not just technique, but thinking frameworks. Filters matter more than information. Quantity, structure enables better decisions. Risk management preserves capital. Systematic approaches beat random action. Simple often outperforms complex. Darvas proved these decades ago. With modern tools and knowledge, application evolves, but principles endure. This is bigger than trading. The Darvas method represents something larger. It's about creating order from chaos, building systems over hoping, managing emotions through structure, taking responsibility for outcomes. Box equals framework, breakout equals opportunity, stop equals protection, trail equals growth management. Build your systems, define your criteria, follow your rules, protect your downside. This is more than market philosophy. It's a declaration of systematic thinking, independence from randomness, independence from emotion, independence from external validation. You're not just learning historical trading methods, you're discovering systematic decision-making. The question isn't, what will markets do? The question is, what does my system indicate? Join yourself in disciplined practice. Use structured thinking. Show yourself that clarity beats chaos. Your learning path awaits. The choice is yours. You don't need perfection. You don't need to catch every move, but you do need to begin. Your first step, the 30-day learning challenge for the next 30 days. 1. Study charts for 52-week highs. 2. Observe consolidation patterns. 3. Note box formations. 4. Track breakout behaviors. 5. Document volume relationships. 6. Journal observations and learnings. Do this without risking money. Pure education phase. At month's end, you'll understand more than most retail traders ever learn, because you're not chasing, you're studying. Continue your education. This is just the beginning. Read original sources. Practice pattern recognition. Keep detailed notes. Master risk calculations. Learning markets takes time, like any skill worth developing. Final thoughts. Darvas didn't find success through magic. He found it through systematic observation and disciplined execution. He danced, he simplified, he followed his rules, and in doing so, he left lessons worth studying. Complexity is often the enemy. Master the basics. Follow your system. Manage your risk. The Darvas box isn't just a chart pattern, it's a thinking tool, where chaos becomes structure, where observation beats prediction, where discipline compounds results. You're not here to replicate history, you're here to learn from it, and perhaps discover your own systematic approach. Now, begin your observation, because you don't need Wall Street. You need discipline, education, and systematic thinking. P.S. 6 months from now, you'll either understand these patterns deeply or still be searching for magic formulas. Which student will you be? Remember, this journey is about education, not promises. Your results depend entirely on your effort, discipline, and risk management. Markets reward preparation, punish carelessness, and respect those who manage risk wisely. Study well. Start small. Stay humble.